My greetings to everyone. I am Professor Namita Rajput, Professor in Department of Commerce, Sri Aurobindo College, University of Delhi. In the ongoing series of entrepreneurship and new venture planning, today we will be talking on the financial arrangement. Arrangement of funds. Yes, it is a very pertinent topic for all the students to understand. The sources of finance for a business are broadly arranged according to the period, ownership and the source. By period, financing is categorized based on the duration, like the medium term, the long term and the short term. Typically extending beyond the years, it is essential for the significant investments such as purchase of the fixed assets, expanding the operations or modernizing the infrastructure. The medium term finance, which spans 1 to 5 years, supports the need like machinery, purchases, working capital or the minor business expansions. The short-term finance used for up to 1 year focuses on managing the daily operation expenses such as paying the wages, buying the raw material and meeting the immediate liquidity requirements. By ownership, the sources of finance are classified as own capital and the borrowed funds. The own capital refers to the funds contributed by the business owners or the shareholders, including the retained earnings. This type of finance provides the permanent capital and enhances the business stability, but may dilute the ownership control and if the new shareholders are involved. So, in contrast, we can say the borrowed funds are raised from the extended sources like banks, financial institutions, or the public deposits, while the borrowed funds can meet the urgent or the large-scale financial needs. They increase the financial risk due to the fixed repayment and the interest obligations. And by source, the finance is divided into the internal and the external sources. The internal sources are generated within the business, offering a self-reliant means of raising the funds through the methods like retained profits, depreciation reserves or selling the surplus assets. External sources involve the funds obtained from the outside entities such as the banks, investors or the public. So, this includes the issuing of the shares and debentures, tasking the loans, taking the loans or leasing the internal sources reduces the dependency on the financial liabilities, while the external sources enable the access to the larger funds but introduce the obligations and the external stakeholders' involvement. So, based on the different categorizations, some of the sources of the funds are as follows. The first is the arrangement of funds in terms of the share capital, the retained earnings, debentures, public deposits, lease finance, bills of exchange and the bank financing, venture capital, angel investors, business incubators and accelerators and the other funding sources. So, first we will be talking on the share capital. The share capital is the amount of money a company raises by issuing the shares to the public or private investors. It reflects the ownership in the company and the forum a critical part of its financial structure, shareholders and in return receive the specific rights including the rights of the dividends and a share in the company assets and if the company is liquidated after paying off its debts. So, let us talk about the different types of the share capital. First and the foremost what we are going to discuss is the equity shares, that is the ordinary shares. Equity shares represent the ownership in the company and the equity shareholders have a claim on the residual profits and the assets after all other obligations are settled. They bear the highest risk but stand to gain the higher returns through the dividends and the capital appreciation. The equity shareholders having the voting rights, allowing them to influence the major corporate decisions. Now, the different examples what we are going to discuss, let us take the first one. If a company like Infosys Limited issue 1 million equity shares at rupees 100 each, the investor buying these shares become a part owner and the voting rights and the variable dividends depending on the company performance. The second is your preference shares. The preference shares entitle the shareholders to fix the dividends paid before the equity dividends, and in case of the liquidation, the preference shareholders are paid before the equity shareholders. Generally, they do not carry any voting rights. For example, a company like Reliance Industries issuing the preference shares at about 8% fixed dividend means that these shareholders will receive their dividends first, irrespective of the company's profit distribution to the equity shareholders. Now let us discuss the merits of the equity shares. The first and the foremost is the number fixed obligation. So, equity shares do not require the company to pay the dividends compulsorily. The payments are made only when there is a profit, offering the financial flexibility. Let's have a startup here. Example, a startup may choose to reinvest its profit for growth rather than paying the dividends, which would not be possible with the interest-bearing debt. The second is your permanent capital. Equity capital does not have to be repaid during the company's lifetime, making it a stable and the long-term sources of funds. The company like Tata Steel maintain a large equity base that supports the continuous business operations without the repayment pressure. The next is your creditor security. A higher amount of equity capital assures the creditors that the company has a financial cushion, increasing its credit worthiness. For example, a company with 100 crore equity is more likely to secure the bank loans as the equity capital provides a financial safety net. The next is your leverage benefits. Equity capital enables a company to borrow the additional funds, that is the debt, allowing it to leverage its position and expand the operations. For example, a company using its equity as a foundation might raise a further debt to invest in the new projects while keeping the control of the financial risk. Now, let us discuss the limitations of the equity shares. The first is your high returns expected. Equity shareholders expect a sustained returns through the dividends or the stock price appreciation due to their high risk exposures. For example, if a company consistently performs well but declares the low dividends, it may face the shareholder dissatisfaction affecting the stock prices and the reputation. The next is your no tax savings. The dividends paid on the equity shares are not treated as an expenses in the company's income statements. This means they do not reduce their taxable profit, unlike the interest on the debt. For example, while interest on the bank loan is deductible under the tax laws, the dividend payouts are made after tax profits, increasing the overall tax burden on the company. The next is your control issues. The equity shareholders, especially those holding the significant shares, may exert the influence over the management decisions and sometimes not aligned with the company's long-term objectives. Again, let's explain this with the help of an example. A group of dominant shareholders, they may block a strategic merger simply to protect their own interest rather than company's growth prospects. The next is your risk of overcapitalization. Issuing too many shares may lead to excessive capital relative to the company's needs, resulting in inefficient capital utilization and reduced earning per share. For example, a firm issuing shares far beyond its operational funding requirement might see the share prices drop due to the capital perceptions on inefficient fund use. The conclusion: the equity share capital is an essential element in any company's financial structure, offering the permanent risk-bearing funds that provide both the financial stability and the strategic flexibility. However, the reliance solely on the equity can lead to the challenges such as increased shareholder expectations, control dilution, and the potential overcapitalization. So, therefore, the business must balance equity with other sources of finance like debt and the preference shares to optimize their capital structure. The next is your balanced capital structure insight. Leading corporations maintain an optimal mix of equity and the debt to minimize the overall cost of capital, while preserving the control and ensuring the financial flexibility. The next is your retained earnings. Retained earnings refer to the portion of a company's net profits that are not distributed as dividends but are kept within the business for the future use. It represents an internal source of finance available to the company. Now, the next is your retained earnings. Yes, as the name suggests. Rather than raising the funds through the external sources like the loans or issuing the new shares, the companies can utilize the retained earnings to finance the business operation, expand the production, and invest in the research and the development, paying off debts or meet the unforeseen expenses. The next is your retained earnings merits. Let's talk about what are the advantages of the retained earnings with a lot of relatable examples. The first and the foremost is it has no additional cost to the firm. The retained earnings do not require the interest payment or the dividend obligations. For instance, a manufacturing firm expanding its plant using the retained earnings avoid the bank interest rates that would apply if it looks a loan. The next important advantage of the retained earnings is it strengthens the firm's financial position. By reinvesting the profits, the company's assets increases and enhancing its balance sheet. For example, Infosys Limited in India has often relied on the retained earnings to build the reserves and increasing its financial stability. The next point is here, it acts as a cushion during the tough times. The companies with healthy retained earnings can use these funds to survive during the economic downturns. For instance, during the COVID-19 pandemic, many businesses utilized the retained earnings to manage their operational cost without seeking any external debt. It also helps in preventing diluting of control. Since no new shares are issued, the existing shareholder, they maintain their ownership percentage. For example, a family owned business like Dabur India, they often prefer retained earnings over issuing the new shares to keep the ownership within the family. Next is, it provides the funds for redeeming the shares and debentures. The retained earnings can be used to buy back the shares or redeem the debentures when they mature. For example, the Tata Motors has redeemed the debentures using the internal reserves rather than raising the fresh funds. The Hindustan Lever Limited, that is HUL, has maintained a steady dividend payouts thanks to accumulated earnings. The next important advantage of the retained earning is it increases the investor confidence. A company with a strong retained earnings signals the financial strength, making it easier to attract the investor or obtain the bank loans. For example, Maruti Suzuki high retained earnings have enhanced its credit worthiness in the financial markets. It also contributes to the industrial growth and the capital formation. When the companies reinvest the earnings, they contribute to the job creation and the industrial development. For example, Reliance Industries. They reinvest the substantial earning into the new venture like Geo Platforms, stimulating the economic growth. Now, let's cite the flip side of it, that is, what are the possible limitations or the disadvantages of the retained earnings with some relatable examples. The first is investor preference for dividend. Some investors, particularly the retirees and the dividend income investors, they may prefer a regular cash dividends over the company's retained profits. For example, the shareholders of ITC Limited often debate between receiving the higher dividends versus the retained earnings for the future growth and the possibility of the misuse by the management. There is a risk that management may use the retained earnings of the personal interest or for projects that do not yield the expected returns. For example, a company investing in an unrelated business venture using the retained earnings may face losses. The next is your risk of inefficient investments. The retained earnings may be invested in low return projects rather than high growth opportunities. For example, if a retail company invests the retail earnings into an outdated IT system rather than digital transformation, it may miss a growth opportunity. Next is your overcapitalization. If the retained earnings are continuously accumulated without the proper utilization, it can lead to overcapitalization. This may reduce the return on equity and impact the share prices. For example, a company issuing a frequent bonus shares from the retained earnings without matching the growth can dilute the per share earnings. Next is your practical corporate examples. There are some real companies using the retained earnings. For example, Apple. Apple retains a significant portion of their earnings for profit innovation and the share buybacks. Next is your Infosys. It uses the retained earnings to strengthen the reserves and ensuring the self-reliance for the future expansion. Then we have Tata Consultancy Services, that is TCS. It also maintains a balance between paying the dividends and retaining the earnings to support the long-term projects. So as of now, we have discussed two, and let us conclude about the retained earnings now. Retained earnings, as we have discussed already, are a very vital source of the finance. It promotes the self-sufficiency and the long-term growth for the companies because they don't have to take the loans and the debts from the outside world. While it offers the cost-free capital and it also enhances the financial stability, more grip on the management, and it must be managed wisely to avoid any misuse and inefficient investments or the shareholder dissatisfaction. Because shareholder dissatisfaction is one thing which can cause a big chaos in the company. Now, a balanced approach between the distributing dividends and retaining the earnings, they often work best for sustaining both the company growth and the investor trust. Now coming on to debentures. Debenture is a formal instrument which is used by the company to acknowledge a loan taken from the investor. It represents a promise to pay back the principal along with the interest at the fixed intervals. Debentures may be secured, that is backed by the company assets, or unsecured, that is an interest paid on them is treated as a tax deductible expense. And this form of borrowing does not include giving up equity, making it an appealing funding option. Now coming on to the merits of debentures. Increased earning for the shareholders. Since interest paid on the debentures is tax deductible, it lowers the company's tax liability, and as a result, the net profit increases and benefiting the equity shareholders through the higher earning per share. Now let's take an example here to explain about the debenture. If XYZ Limited earns 10 crores in the profit and pays 2 crores in the interest on the debentures, the taxable income drops to 8 crores. This reduces the tax payment and improves the earnings allocated to the shareholders, raising their earning per share. Now the control retention. Debenture holders are the lenders, they are not the owners. So they do not get any kind of voting rights, which means that the management and the equity shareholder, they retain the full control of the company. For example, a family owned company like Bharat Textiles Limited, they want to raise 5 crores but does not wish to dilute the ownership. By issuing the debentures, it obtains the funds without giving voting rights to the outsiders. There is a flexibility in the capital structure also. The companies can maintain or modify their capital structure by issuing or redeeming the debentures based on the financial needs, unlike the equity, which is a permanent capital. Let's take an example. The LMN Private Limited issues the 10 crores in debentures to fund a new plant. After the years, once the profits stabilize, the company redeems the debentures, reducing the debt and improving its balance sheet. It is also a cost-effective funding. Debentures are generally less expensive than the equity or the preference shares. The interest rate is usually lower than the return expectations of the equity investors and the tax benefits. Further, it reduces the cost, and for example, if ABC Limited issues the debentures at 8% interest while equity shareholders 8% interest while equity shareholders expect a 14% return, debentures becomes a more economical choice of raising the capital. There are assured returns for the investors also. The investors resolve the fixed interest at a regular interval and are assured of return of the principal on maturity, making the debentures a very attractive low risk investments. Like for example, a retained individual invests 10 lakhs in debentures of a reputed company offering a 7.5 annual returns. So this provides a predictable annual income of 75,000 and the principal resolution and also the protection. Thank you very much.